Steve Peterson here with Infinity Investments, and welcome to our channel where we talk all things commercial and investment real estate. In today's video, we're going to be talking about three different methods of creative seller financing. Now, December 2022, we all know that, we're in a high interest rate environment, we're in a high inflationary environment, right? In commercial real estate investment business, at least here in the Bay Area, NorCal, I can say, the amount of transaction volume has really, declined a lot, right? The amount of deals getting closed is down significantly. Prices are down slightly, but more than the prices, the transactions. That's what, as brokers, that's what keep us going. So I want to talk to you guys, this video, I'm going to talk about the three main creative financing methods that I've used and been able to close deals as a broker, also as an investor. So this will help you guys, if you're investors, if you're brokers, right, to be able to bridge the gap and close deals, all right? The first method is the most traditional way for sellers to carry finance, and that's going to be a seller carried first or second position deed of trust, all right? I'll give you an example. I just closed a deal where the seller carried about 70% of the purchase price, first position mortgage. Now, they didn't own this property free and clear. So how did they do that? They had a couple $100,000 of debt. So what happened is the buyer came in with their down payment. So they had a down payment, 30% down. The buyer's challenge was, hey, if I'm gonna go in the marketplace right now, I'm looking at 6.5%. I'm buying vacant commercial property. That's tough. So what we did was we structured a way for the buyer to come put their down payment in. The down payment that the buyer put down, that paid off the seller's debt. And then basically the seller carried their equity in the form of a note, and we negotiated a rate that was lower than the going rate of today's bank. In fact, a really sweet deal, actually. And then that makes the deal happen. It gets the deal done. It gets the seller's debts paid off. They have some debts they needed to get paid off, and they took their equity and carried it in the form of the note. Now the property was vacant. They weren't generating any income on there, so their equity was generating a negative return for them, right? They had payments and taxes and all this stuff. Now in this deal, they get the payments off their back, and now they're generating a positive return on their equity, as a lender. All right, so that's the first position. Now, deals passed deals that I've worked on. So a deal I worked on this year that we closed, where we went out and we had the seller carry a second position mortgage. They carried about a 20% seller carry. We went out and got a deal. We got a 65% mortgage and then had the seller carry in the second position. We came in with 15% down. We ended up coming in with like almost 25% down when you looked at all the costs and the carrying costs and the prepayment of interest and everything like that. What that allowed us to do, right, is to purchase a property with less money down, a property that needs a lot of work. We're going to renovate and do that. And what it allowed the seller to do was sell a property that just wasn't selling. They've been trying to sell it for a while. They dropped the price. It needed, renovation. It needs a lot of work. It fit our model, but we just didn't want to put 35% down plus all the cost of capital is some renovation project, right? So 35% down actually ends up being 45% down when you look at all the cost of capital, right? So it solved a problem where the seller got the majority of their money up front, and they just carried a second. Now, is there risk in this? Yeah, of course. So the seller is behind the first position of mortgage, right? But as we explained to the seller, hey, you're in front of us. We put in capital pretty much equal to your down payment. And then we are going to do all the heavy lifting of doing the renovations, doing the project and doing this. And so that we are invested in this together. But it allowed the deal to close, and they got the majority of their money. Most of the money, the deal got done, right? We got in with less money down. That increased the rates of return. Also, both these deals, by the way, I just mentioned to you, full commissions were paid. All right? Full commissions were paid on that. So a lot of times agents, brokers realize that you shy away from seller financing because you don't understand that we can get paid within this, structure. All right. Sometimes it might involve taking a little bit less in commission, but 100% of something, a little percent of something is always better than 100% of nothing, right? So just the method. So that is the number one way: seller carry traditional first and second deeds of trust. Now, second way, master lease option. All right, master lease option. In the residential world, that's going to be lease option. In our world, it's the master lease option because we got more than one unit. We got a big commercial space, right? And so where you come in and say, Mr. and Mrs. Seller, or if you're the seller or buyer, we execute a lease that is a master lease for the building, right? So the seller is trying to sell a property. Maybe for whatever reason, it's a tough sell. And right now, financing, inflation, volatility, but it's maybe generating some income. And maybe your reasoning for selling is you don't want to manage it anymore. That's the biggest, where we see this strategy being used, is people who don't want to manage the property anymore. Would you agree that managing property takes some work? All right? Especially when you're an owner manager. So a lot of smart people hire a property manager, but a lot of people just do the management themselves and they get burnt out. Right? If you don't have a system, you're dealing with the Bay Area rental laws, things like that can get challenging. So what you can do is master lease it out to another seller, or if you're a buyer, or if you're the buyer, you approach the seller with the master lease. You pay it, the seller gets an amount per month, lease, pay it to them every month, right? What is the difference is there's an option agreement. An option agreement from the buyer to the seller, where the seller gives the buyer the option to purchase the property. And there's generally a fee for this called option consideration. And that fee, in my experience, is typically anywhere between 1% and 5%, because option consideration is not an earnest money deposit. It is completely non-refundable, right? So when you give that seller that money, you purchase the option with that option consideration. It's not a deposit. But it's usually, I like to be in the 1% to 3%. Some people I've seen 1% to 5% range, because it's non-refundable, but it gives you a period of time. And I like to try to negotiate these, depending on the situation, 2 years, 3 years out. If you could do a 1 year option, but you're putting yourself in a real tight window of time to close that deal. Because when you purchase an option on the property, you have to buy that property within that period of time. Now, you also can sell that property, right? But that property's got to transact within that period of time, or you lose your option consideration. Right? This is a great way to purchase and acquire real estate. This is a great way to sell real estate if you're in a market like this where it's stagnant. It's just very difficult times, because when these interest rates are high, when you are a seller, you got equity, you can be creative with how you finance the property. You don't have to rely on the banks. And I think that's my point I'm trying to get across to the marketplace, is that, look, yes, these interest rates are high. Look, they got to keep them that high, because we don't want to go to the store and pay $25 for a gallon of milk, all right? That would kill everything. So that's what they're doing this for. Whether we like it or whether we don't like it, we got to bob and weave through it, right? And so if we come up with these creative methods, if I'm trying to sell a property, and maybe your biggest objective is the management is kicking my, it's not working for me, then you could consider selling it with the leasing with an option to buy, or carrying a seller, or carry first or second deed of trust, right? But if you do a master lease with option to buy, what you effectively are giving away as a seller is what's called equitable title. And the owner obtains equitable title, which is where they now have a form of ownership called equitable title, which gives them rights to the title so long as they perform under the covenants of the lease and the option, right? It is a form of ownership. You don't own it outright. You do control it, but you don't own it outright. You have rights to the title, which means you can buy it, you can also sell it. So another creative way to get done. Now, one thing to mention on that is the option consideration goes toward the purchase price. So if you're able to execute the purchase or you sell it, the money you put up is a credit toward the purchase price. And what I like to try to negotiate, especially when I'm on the buyer side, is a percentage of that monthly master lease payment. Anywhere between 1% and 5% goes towards the purchase price. So it's like, it acts as like principal pay down of a mortgage. That's the wild, wild west. You negotiate whatever you can. But just another way of getting the deal done. And the last thing I want to talk about is a land contract. California, we call it a contract for deed. Very, very, very similar to a master lease option, different in a couple different ways, because This essentially is what's called an installment sale, right? The property is being sold in installments, okay? Very, very similar to a lease with option to buy, but different in a couple different ways, because there's not necessarily a lease, if you will, all right? And there can be monthly payments, but there doesn't necessarily have to be monthly payments, all right? Give you an example on a property I sold like this a few years ago. It was a church in San Jose, right? When the market crashed, before it was up, and this was a very creative way to get a deal done. And it was $1 million something. I represented the buyer. The buyer came and said, hey, we want to purchase this property. We don't have all the down payment, but we have the ability over a period of time to, pay you lump sums of payment. And then we want to occupy the property, have our church here. So what they did is say, we're buying, it was like $1 million, $2 or whatever it was. And they said, we're going to put $50,000 up front. That's our first installment. Every quarter that goes by, we're going to put another $50,000 for 6 quarters, a year and a half. And then at that period of time, we'll cash it out. We'll buy the building, right? So that was very similar to the lease with an option to buy, because at that point, when the buyer puts up that first $50,000, they get equitable title rights to the title, right? They don't own the property, so the title is still with the seller. So you have rights to the deed, to the title, to the ownership, so long as you follow through with the covenants in the agreement, right? And what we did I put this together as a broker. Each payment, and there was a listing agent, and I proposed this to the listing agent. He thought it was a great idea. I said, hey, look, why don't we take half our commission up front, and then the rest of the commission we break down each time they make a payment, right? Because it wasn't a lot, the seller didn't get a lot. They was asking for, $1 million something, and they got $50,000 up front. So it's kind of like hard to ask them for the whole commission that month at that point in time. But we got half of it, and then over time, we got the rest of it. It was a creative way to get a deal done. Buyer was happy, seller was happy. They came through. Brokers, both who represent the buyer and the seller, we all was happy. We got a deal done. All right, and the biggest thing, what I wanted to talk to you guys about today, is these 3 creative ways. Traditional seller carried first and second deeds of trust, master lease options, and contracts for these, as ways, just ideas, thoughts of how you can structure a deal to close in this high interest rate and high inflationary environment. Now, those are just the top 3 ways I see getting creative financing done. There's all kind of other strategies subject to acquisition, wraparound mortgages, right? And the list goes on and on. Syndication, joint venture development. There's all these things you can do to get deals done, right? And maybe I'll do some more videos on that. In fact, you may check this video out right here that I did on creative finance in general, where I go deep into some of these strategies, right? So I hope this is helpful. We just got to be creative. Times like these are going to test who you are. It's time to, stand strong, don't buckle, and think creatively in order to solve problems and get deals done. Hope it was great. If it is, like it, share it, subscribe, share with friends. To the next video. Deuces.